Hello and welcome to the Home Loan Masterclass. Today you're going to learn how to buy or refinance a home in 6 easy steps. My name is Jay Robbins. I am your host, and let's get right into it. First, we're going to talk about what you're going to learn today. What you will learn is the entire mortgage process in 6 easy steps, from very first thought of wanting to buy or refinance to waking up the morning after everything is official without guessing or silently questioning, and most important, with peace of mind. You're also going to learn how to save thousands of dollars of cold, hard cash out of your pocket up front. Who is this for? This is for anyone who's wanting to buy a home, anyone who already owns a home, real estate investors, and a real estate investor, in my opinion, is someone who is earning or wanting to earn money outside of the home that they live in right now. This is also for any renters who are wanting to buy a home, and anyone who owns a home and wants the best money wellness situation. Who is this not for? This is not for anyone who knows everything about real estate and mortgage lending, because you're probably not going to learn that much. This is not for anyone who's not interested in getting a mortgage to buy a home. There are exceptions. If you are watching this to help someone else, then this is for you. Anyone not interested in having the best mortgage for your existing home. These are all the folks who this is not for. My goal today is to give you the knowledge and wisdom to feel empowered to make the best choice and decision so you can rest easy at night. Now, please be sure you stay till the end, because if you stay till the end, you're going to learn how to get a credit for hundreds and even thousands of dollars toward your home from me, the mortgage lender, as a result of this online course. You're also going to learn a technique to save thousands of dollars in cash out of your pocket up front if you're buying a home. If you are refinancing, I'm going to show you how to lower your costs very simply. Also, if you stay to the end, you're going to receive a how-to budget worksheet and consultation. This is valued at $200. You're also going to get a complimentary credit report consultation to help you understand your credit report and have tactical actions to raise your credit score for life. So this is knowledge, wisdom, and education that you're going to be able to carry on with you for the rest of time. And this way, you'll never need a credit repair company. You'll never have to question what's happening to your credit report, because you'll understand it and you'll have optimal credit score all the time. This in itself is valued at $500. All of this simply for staying to the very end. So simply for staying to the end of this webinar, you're going to get the techniques that I share with you that are going to save you thousands of dollars in cash up front, keeping it in your pocket. This is valued at thousands of dollars in itself because of the amount of money in cash that you're going to save out of pocket that you can use for other things. The budget worksheet and consultation, which is valued at $200, and a credit report optimization consultation, where we're going to go through your credit thoroughly to figure out what we can do to raise your score so you can get the lowest interest rate when you go to lock it. That's also valued at $500. So altogether, simply for staying to the end, you're going to get $700 worth of bonuses plus thousands of dollars cash in hand, especially on a purchase, as a result of staying to the end, and this is all free to you. Distractions distract. Please close your apps, turn off notifications, and set your phone on airplane mode to get the most of this online class. Now, most of you are watching this via the internet, so you can't go on airplane mode, and that's fine. But if you want to really be efficient, then text messages, emails, anything that can distract you from watching this may cause you to miss some information that could be that one nugget that's going to really take you over the top in what you want to accomplish. So what makes this course different from maybe some other courses out there? Well, in my opinion, there's no one else out there that I've seen that is able to share these steps in an easy way that makes sense, and that has been through 21 years of ups and downs in the mortgage, credit, and real estate industries. Now I'm going to get into my background a little bit so you have an idea of where I'm coming from and how I have this wisdom and knowledge. And as you can see, the white hairs in my beard and on my hair are the result of the wisdom that I've absorbed and earned over the years that I'm going to be passing on to you. I started with a real estate investment course back in 1999. Most of you who can remember before the internet really took off, they used to have infomercials that would be on pretty much after regular programming, and there was a gentleman who sold a real estate investment course. I bought it, I jumped in and started doing well with it right away. And then in 2001, by a fluke, I met someone at a random moment in time that offered me a job in the mortgage industry. I didn't know much about mortgage lending. I just knew it had something to do with real estate. We had a conversation, one thing led to another, and within 48 hours, I was in the mortgage business. That was in 2001. A few years later, it was time for me to move on and really build and grow. And at that time, I opened up a mortgage branch for a major lender, and very fortunate, had a great experience. And then about 40 years later, roughly, that's when the market crashed, and so did I. So when the market crashed, and some of you might know the phrase mortgage market meltdown, I started a company to help people get through this time. Because I was going through my own issues, I realized, well, I'm in the business, so I know a lot, but what about all the people that don't know what I know? And so I started helping people get through short sales, foreclosures, bankruptcy, loan modification, debt consolidation, credit repair, and a few other ancillary services that had to do with liability and what was happening at that time. As a result of what I went through based on my own experience personally and helping all of these folks for several years, this added to my industry knowledge and strategy creation for home buyers and homeowners, which brings us to this particular masterclass. In 2012, the market started to correct itself. So I had done those previous services for about 4 years or so, still remaining in the business. And then in 2012, I started doing mortgage lending again exclusively. By then, everyone had pretty much resolved their issue for the most part. Things started slowing down, which was a good thing. And then the forward mortgage, people purchasing and refinancing regular mortgages, started picking up again in 2012. And at that time, in 2012 to today, I do exclusively mortgage lending for real estate. Close to 100% of my business to date has been referrals from family, friends, past clients, and referral partners, such as realtors, accountants, financial advisors, and other professionals who put their clients' trust in my hands. I'm ranked one of the top-rated mortgage lenders in South Florida based on over 140 reviews via Social Survey and Zillow. Social Survey just became Experience.com. I'm the husband to my beautiful wife and father to my first son at age 45. So I started as an older dad, and there's something that goes with that, right? When you're a little bit older and you go through life, you tend to have a little bit more patience. You tend to have a different perspective and appreciate things more. So I'm very grateful. And my son, of course, keeps me very busy and active, which is always good as we get a little bit older. I was born and raised in Baltimore, Maryland. I moved to Florida in '99, about the same time I purchased that real estate investment course, and I've been a Florida resident since then. In my non-career time, because we have work-life balance, right? So outside of my career and being creative to help more people and serve more people in their homes when it comes to real estate and their liability management, one of the ways that I really am able to serve and be the highest version of myself is the time that I spend outside of my career. And so for fun, I like to spend most of my time with my wife and son. When I'm not spending time with my wife and son, I'm very specific in putting time aside for my personal space, which is I'm working on my mind. I am making my body healthy by exercising, whether it's cardio or strength training or core work. I'm working on my spirit, my soul, to make sure that my energy is as pleasant as possible all the time, and I'm always aware of what's happening. Being creative is very, very important, and this is all for growing in all areas. I like doing things that bring me peace, like hiking and cooking and anything that keeps me relaxed. This pic, as you can see, of the waterfalls is on a hike. I was in North Carolina in the mountains for a little while, and there's something to be said about nature, how medicinal it is, and how it can inspire lots of creativity. So these are the things that I like to do for fun, and which is relaxing when I'm not serving in the mortgage and real estate industry. I'm also a wisdom absorber and sharer. So, wisdom, in my perspective, comes from experience and then using that experience to apply to my overall well being that I can share with others. So, I take a lot of pride in that. Knowledge is one thing. Knowledge is if I read a book, I know what the book says. But if I'm not implementing it, then it's not wisdom. So, I really get a lot out of serving and sharing wisdom for those who want to hear it, which is one of the reasons you're on this webinar today. So, what to expect? Upon completion, you will feel empowered with knowledge and wisdom on how and when to take the next steps to buy or refinance a home. And you'll understand realistic expectations in buying or refinancing your home, whether it be your primary residence, a second home or vacation home, or an investment property. Kind of give you an idea of what other people are saying about their experience, which I believe is very, very important in today's environment when you're choosing on a service provider, even a product. You know, Amazon is known for a lot of their products are the most popular products that Amazon sells are based on the amount and ratings of the products, how many stars someone gives. Even personally, when I'm purchasing something off of Amazon, the first thing I'm looking for is how close is it to 5 stars and how many people have given those reviews. And that's, in my perspective, a telltale sign of that this is going to be a good product. I feel the very same when it comes to service, whether it's mortgage lending or real estate or a local restaurant or a local contractor. See what other people are saying. And so at this moment, I'm approaching 150 reviews. Some of you may be watching this after I've exceeded 150 reviews, and I encourage you to take a look at what people are saying. Here's a couple of things. My reviews are from folks who I've done a mortgage for, they've closed, as well as some real estate professionals that have referred me business over the years. So you can see some of the words that are bolded in red and what the 5 stars are. And here's another one. And up in the upper right-hand corner, you see I listed one that shows 4.5 stars because I can't expect everyone to see how great their experience was. And listen, there's going to be bumps and bruises in getting a mortgage. There usually is. But how you experience those bumps and bruises, in my opinion, is key. What is your perspective? How's the information being delivered? So this particular client who gave 4.5 stars, I remember I went way out of my zone of what the normal serving was to really, really step out and help her because there was a lot of bumps and bruises, but I still got that rating, and that's going to happen. But it also shows that, listen, this is real and we're all human. But I'm very grateful that almost every single one of the reviews I have are 5 stars, and you can see that for yourself and just see what other people are saying. So now we're going to get into the 6 easy steps to buying or refinancing. Step number 1 is the initial consultation. Step number 2 is the pre-approval process. We're going to get into the steps of each of these. Step number 3 is processing and underwriting. Step number 4 is the conditional approval. So it's gone through processing and underwriting. We're going to get into that. Step number 5 is reviewing the numbers and getting a clear to close simultaneously. And then number 6 is the day of closing. So first, let's start with the initial consultation because this is the most important part of the entire process. So the initial phone call, email, or text is going to go over the goals, objectives, situation, timeframes. I personally like to do a phone call because it gives you the opportunity to get everything out of your mind that might be in there. And I really don't care how long it takes for you to share everything on your mind because quite frankly, personally, I want to hear everything. This can also be done via email. In today's environment, most people aren't able to make phone calls at certain times because they're working or they have families, so maybe an email is best. In my case, I even am able to go back and forth via text. I prefer a phone call, but email and text is also an option, and I understand how life can be. And what we're doing is it's an informal communication. It's getting an idea of, again, your time frames, what you want to be doing, so we can start to create the game plan or the strategy in moving forward. So in this initial consultation, we're going to be speaking about debt, income, credit, equity. As you can see, there's an acronym DICE. Debt stands for how much do you owe per month. Like when we pull your credit report, how much debt is going to show on your credit report: credit cards, car loans, student loans, other mortgages. Also included in what your debt is what your mortgage payment will be once you close. So that's the debt. Your income is how much money is coming in each month or each year. So if you're a W-2 employee, then you get pay stubs every week or every 2 weeks or once a month. If you are a 1099 employee, that means you're a subcontractor, you're self-employed. So we're going to need to look at 1099s as well as your tax returns. If you are self-employed, we're going to need to look at your tax returns, both personal and corporate. And this is for an institutional loan. So in a lot of cases, there are some products on the market now where if you're self-employed and you haven't filed your tax returns, or the income on your tax returns are not as high as you want them to be, there are options, which is on another video, but there are options for folks out there who are self-employed and can't use tax returns. In our initial consultation, we're also going to talk about credit. What's your credit score the last time you checked? If you don't have your credit score, that's okay. We want to talk about what might appear on your credit. Is it excellent, good, fair, or poor? What makes you say those things? Did you have a major credit event? So we're just trying to get a scope of what not only your credit score is, but what would appear on your credit report before we actually pull it. And then equity is essentially if you're purchasing, it's how much money you're putting down, right? So if you're buying a $300,000 house and you're putting down $15,000, that's 5%. So you have 5% equity. So the equity is the difference between what your mortgage balance is and what the home is worth. So on a refinance, if your home is worth $500,000 and you owe $300,000, then you have $200,000 in equity. So we're going to talk about that as well. If you're buying a $500,000 home and you're putting down $200,000, then you're putting down 40% equity. So we want to talk about how much cash do you have allocated to purchase the home, which is the equity. If you're refinancing, and we want to talk about what you want to accomplish, whether you're just lowering the interest rate or you want to take cash out or you want to pay it off sooner, the equity becomes an important part of getting pre-approved for a mortgage. The other thing that we're going to talk about on the initial consultation is your budget. Now, on a refinance, there just has to be a benefit, right? We're really not talking about budget. We're talking about what do you want to accomplish, and by moving forward and going through the actions of doing a refinance, do we accomplish what you want to, and is there a benefit? That's important. If you are purchasing, your budget is what you're willing to pay on a monthly basis. So there are actually two different numbers for budget. One is what you qualify for. That's going to be determined by your income and your debt and your credit and your equity and DICE. That's what you qualify for, and that's one of the numbers. The other number is what's your comfort level. Because let's assume you want to buy a home, and let's say based on your income, you qualify for a $5,000 mortgage payment, but you only want to pay $2,500 a month. Well, then we know that your budget is $2,500 a month. So qualifying for a $5,000 payment, if you do, becomes irrelevant, because we want to make sure that your budget, which is $2,500 in that case, you can qualify for that. So we're talking about your budget, how much you can buy if you want to, and then what is your budget and where do we want to be when the dust settles. And the great news is you're in control of your budget. So we're also going to talk about the cash allocated to close. This goes back to the equity portion of the DICE acronym. There are a couple of numbers. So one is how much liquidity do you have, meaning how much cash do you have in your checking and savings? Do you have a 401k? Do you have an IRA? Do you have mutual funds? Do you have stocks? Any other financial instrument? That is cash. We consider it cash that if you needed to access it, you could. And that's one question. How much do you totally have in all those different accounts? The next question is, of that cash, how much money are you allocating to close on your new home? Remember, this is for purchase. So if you have, let's say, $100,000 total, your 401k, your IRA, checking and savings, but you are only planning on using $20,000, then we know that the cash allocated to close is $20,000. And of that $20,000, it needs to cover the down payment and closing costs. Now, in my experience, a lot of folks don't pay too much attention to the terminology here when it comes to cash, down payment and closing costs. Some folks might say, listen, I have $20,000 to put down. Well, it's $20,000 to use, because if you only have $20,000, reminder, that $20,000 needs to cover your down payment and your closing costs. And closing costs are the cost to close. And so that is the result, which we'll get into in a little bit. But basically, the closing costs are government, lender, and title fees, as well as prepaid items, which include taxes, interest, homeowners insurance, and other miscellaneous fees that have to be factored in to purchase or refinance a home. We want to be very clear that on the dollar amount that you have that you're planning on using, and then we're going to figure out how to make it work with the money that you have. Now, a couple of other places where you can get some of your cash is, first, you can get it as a gift from a family member. So if, let's say, you have $20,000, but you need an extra 10, you can have a family member gift you the $10,000. Another way to get that $10,000 if you need it is you can ask the seller of the home you want to buy, if you're purchasing, to give you a credit to cover closing costs. And then as a lender, I can also give you a credit, or a lender can also give you a credit, which will be relative to what your final interest rate is. So a little small note, make a note of this. One of the ways a lender can contribute and cover some of your closing costs, or the cash you need to close, is by giving you a higher interest rate than what the lowest would be that you qualify for. So for example, let's say, and I don't know what the rate is when you're watching this, and there's so many different variables in what determines an interest rate. There's another video I did that talks about how an interest rate is determined. But let's assume your interest rate was 3.5%. And you said, I don't want or need a credit. I want the lowest interest rate, and it's 3.5% or 2.5% or whatever the interest rate is. Then you say, I want the lowest interest rate. I don't want to pay any extra, and I don't want you to give me a credit. I just want the lowest interest rate where it doesn't do either of those things. And then all of a sudden, let's say it's 3 or 3.5%. Or you might say, Jay, I need you to help me. I need $2,000 to cover some of my closing costs. Well, maybe we raise that interest rate 0.25%. So you're paying a higher interest rate, but as a result of paying a higher interest rate, the bank is actually going to give you some money to help you close. So it's kind of a way of financing some of your closing costs because you're paying for it in the interest rate. And it's a technique to be able to get some cash that maybe you don't have. So you have an interest rate called par rate, where there's no cost and you're getting no credit. There is an interest rate called above par, where you do get a credit. And then there's an interest rate called below par, where it actually costs you money to buy down the interest rate, And you may have heard of the term points or discount points. That's what that is. You have the option to pay extra to make the interest rate lower. All of these all come to be determined by how much cash you have allocated to close. So now we're going to go through the pre-approval process, and this is versus a pre-qualification. It's different. So on the pre-approval and going through the pre-approval process, after we've had the consultation, which is the beginning of the pre-approval process, and we're all ready to move forward, one of the next step is we want to make sure that we have a mortgage lending application completely filled out. And this includes your personal information, your name, address where you live now, your social security number, your birth date, how long you've lived where you live now. It also includes your employment, where you work, where have you worked for the last 2 years. It also includes how much money you have in savings, retirement. We look at your credit, what are your liabilities. All this stuff is the application. And it takes about 10 to 15 minutes to fill out online. I personally like to do it with whomever I'm working with over the phone if time allows it, to really kind of get into it and make sure it's nice and clean and tight. But if you fill out the application and it's not perfect, never to worry. And again, I can't speak for other mortgage professionals, but in my particular case, I like to call whoever fills out that application, call afterwards or shoot an email and say, hey, here's some things that we need answers to or clarity. So I personally try to make it really easy. This can be a really stressful experience for most people, especially when you're working with someone who is maybe not so experienced, or even someone's perspective in life. If their perspective in life, if they're a high stressed or high strung person, high blood pressure, they don't take good care of themselves, that's the service provider you're choosing. And you probably will have an experience as a result of who they are outside of their career. So I just think it's really important to pick a mortgage professional who you feel good about, who you can rely on to deliver a good, peaceful experience. And doing the application, we try to make it really, really easy for you. And but that's going to be the first part. After the consultation, this is the next step in getting the pre-approval. The next part of the pre-approval is we have verified all documents. So part of the pre-approval process is when we're having the initial consultation, what I personally do is send out an email, and the email is going to include a list of everything that you need that's custom to you personally. For example, if you're employed and a W-2 employee and you don't have a business, I'm not going to ask you for corporate tax returns. If you are a renter, you currently don't have another home, so I'm not going to ask you for a mortgage statement. On the reverse side, if you are a real estate investor and you want to purchase or refinance one of your properties, then I'm going to need recent mortgage statement, etc. So the documents that we'll need are going to help confirm that everything that's in the application is correct and accurate, so we can make sure we do a really thorough job. Now, a lot of mortgage professionals, for some reason, they don't do this, and that is a pre-qualification in my perspective, to where someone will talk to a home buyer or homeowner over the phone and say, yes, you're good to go based on a conversation. I've never done that in my career because that can lead to a lot of obstacles and issues. What I like to do is give an official pre-approval because we've gone through the application, we verified all documents, tax returns, pay stubs, bank statements, employment, everything that we need, so you can just simply go shopping and pick out what you want. Or if you're refinancing, we can just talk about the game plan and the benefit, and we can just push the button and move forward. So verifying all documents after the application has been filled out is very important and part of the pre-approval process. Once we filled out the application, we verified all the documents, the next step is to make sure that we have a clear strategy. So if you're purchasing, we've talked about your budget. We've talked about how much cash you're allocating. We've gone through the application. We've verified all of your documents. And now we have a clear idea of what your purchasing power is based on all of those things that we just discussed. So then you can comfortably go shop for something, give or take $20,000 to $25,000. In other words, it's never a good idea to be looking for properties that start at 150 and go up to 400,000 because that's all over the place. And it's going to take you forever to figure out. It's kind of like saying, hey, I'm in the state of Florida. I want to get to Colorado. I'm just going to start driving. And so ultimately you want to have a point A, a point B, and then what are the steps to get to point B laid out and accurate. And with that, in my opinion, that is a form of discipline, but discipline in that particular case creates freedom and being empowered as you go shopping for a home. If you are refinancing and we have a clear strategy laid out, it's a matter of you saying, I am clear on what the strategy is. Let's move forward and make this happen. And then we push the button, and roughly 30 days later, you have a new mortgage, and it's what we talked about. Most of the time, it's better than what we talked about. Again, I'm talking about my experience with the folks that I work with. If you're working with other people or you plan to, it's important to make sure you have a clear strategy before you go to that next step. So once we've had our consultation, we've gone through the application, we verified all documents, we have a clear strategy. If you're purchasing, I now issue you what I call an officially stamped pre-approval, because anyone can send out a pre-approval and they can put on there whatever they want. And sometimes it'll work with buying a property and sometimes it will not. If I personally give you or someone you care about an officially stamped pre-approval, it's because we've gone through all of these steps. And in my 21 years of experience, at that point, it's if you're purchasing, let's get a contract and we'll be able to close not too long after that because you, the borrower, are in good shape. Now, just so you know, it's not always that easy. In other words, we can go through all of this and there might be one little thing in there that you didn't think to share, or maybe that we didn't talk about that pops up later, and sometimes it can cause a bump. And that's why I always say to the folks I work with, and my belief is the perfect home is the one you're going to move into, or the perfect mortgage is the one that you're going to close on, because there's always something that maybe was not looked at prior. Not always the case, but it comes up sometimes. But the officially stamped pre-approval has a very, very high odds and likely that everything is going to work out the way that we talked about. But it's important that I disclose that it's not always perfect. But most of the time, working with me and the team that I have, it's a pretty smooth process because of the experience and knowledge and wisdom. So once you have the officially stamped pre-approval, if you're purchasing a home, you can literally go shopping and pick out what you want because you know what your purchasing power is, you know what your payment's going to be roughly, how much cash you're going to need roughly to close, and then you move forward and go pick out what you want. Typically, what most mortgage professionals do is they send out a generic pre-approval with the address to be determined with a certain price point. And I disagree with that personally. I think a pre-approval should be customized because it's not the house price that you're pre-approved for. And this is very, very important. You're going to want to write this down. What you're approved for is your mortgage payment, not the house, because you could line up 3 houses that are $400,000 each, and they're all going to have different payments. Maybe the taxes are different. Maybe there's a homeowners association in one and there's not a homeowners association in another. Maybe the homeowner's insurance is going to be higher in one than the other because of the age of the house or the age of the roof. So it's really, really important to know that when you're shopping, it's not about the house amount that you're qualified for. It's the payment that you're qualified for. And the payment is the result of roughly a price range and roughly what the mortgage balance is going to be. What I like to do to give home buyers and homeowners that really good experience is I like to customize a pre-approval. So when you pick out a property that you like, for example, and you're shopping, you're purchasing a home, and we know we have your budget in mind. So in the previous phone call, right, in our consultation, you said, I want my payment to be $2,500 or less, or $1,500 or less, or $6,000 a month or less. And once you have a property picked out, that's when I suggest send that to me or someone on our team. We'll go ahead and run what we think the numbers will be, more on the conservative side, and see if we're within budget. And so if the answer is yes, like, okay, you want to buy this $350,000 house, you want your payment to be $2,500 or less, according to my conservative calculations, your payment should be under $2,500. And then we customize a pre-approval with that address, the offer amount you're making on that property. And in my experience, that tends to be more valuable for a listing realtor, a listing agent, than it is a listing agent receiving a generic pre-approval letter with an address to be determined or a general price point. So we want to give you a custom pre-approval. We want to make sure that the payment is within budget. And on the reverse side of what I was sharing a minute ago, if you go to find a house and we're thinking the 350 range, and all of a sudden you send it in and the payment as a result of a high HOA fee or high taxes, or high insurance or whatever it is, your payment ends up being $3,500 versus the $2,500 where you wanted to be in your budget, then that's probably not going to be the right property for you. And then there's no point in seeing the property, and there's no point in producing a custom pre-approval, because to purchase that property is not within your budget, the numbers that you feel comfortable with. So we want to make sure we do a custom pre-approval for the property you want. Now, for a refinance, once we go through those previous steps, the application, verified documents, clear strategy, and officially stamped pre-approval, we just move forward into the process and start processing your mortgage to close shortly after we push the button to do that. So now let's talk about processing and underwriting. If you are buying and there is a signed contract, what's going to happen is you or your realtor, if you're using a realtor, will send that to us, and then right away we get your loan into processing. Now, processing means there is a group of people after me that all collectively work on your file to make sure that all the I's are dotted, T's are crossed, and there's movement so you can close at the designated time to close and everything will be smooth. This is processing. At the time when we do the initial processing, because we now have a contract, or again, if you're refinancing, we've decided to move forward, you're going to receive what's called the initial preliminary disclosures. Now, the initial preliminary disclosures are simply a set of items. Most of the time you can do an e-sign or an e-click, which is how we send out the mortgage paperwork, that is just confirming that you are who you say you are. We filled out the application. The application is now in front of you, and you're saying, yep, that's me. This is my name. This is my address. This is where I work. This is what I've gone through. This is my credit, etc. And because there are several unknowns, like we don't know at the moment if you're purchasing what your homeowner's insurance is going to be. We maybe hadn't locked the interest rate yet, so we don't know what your prepaid interest is going to be, or your interest rate. So we don't know what your mortgage payment's going to be. We don't know what your closing costs are going to be, because there are a lot of unknowns. Like, so for example, a little side note, one of the reasons we don't know what your closing costs are going to be is because when you're doing a purchase or a refinance, you have to pay a whole year of insurance in the closing costs. And we don't know your insurance until you get an inspection to determine the roof shape and other factors that will produce an insurance quote for you. So the insurance could be $5,000, it could be $2,000. That's a $3,000 difference in closing costs alone. Same thing with interest rate. We haven't locked the interest rate yet. The rate could go a little bit higher, could go a little bit lower. We won't know until we lock it. That's all relative in a lot of cases to what the appraisal is going to come back at and how much more you need to spend out of your pocket. So there's a lot of unknowns when it comes to numbers. So when we're sending out the initial preliminary disclosures, it's to get the file started so we can get everything into underwriting, and at that time, the numbers are not accurate. Now, in my experience with my clients, we always bear on the conservative side. So most of the time, if not all of the time, or actually, let me just clearly disclose, most of the time, the numbers are what we said or lower. If for some reason they're the same or higher, there's no surprise in the process that I do. We're always talking about it throughout the process. Maybe, like we talked about, one of those things has popped up in life, or as we've gone through the process that maybe you didn't know about, or you did and you didn't think to share it, or maybe it was just a complex, deep down layer that no one really knew to talk about, and then something pops up. And as a result, that can affect the closing costs or the interest rate or whatever the case is. So that's why we say the numbers are not accurate, but they're going to be close from the time we get started and to the very end. Once you, or as you're signing the initial preliminary disclosures, you also want to get an inspection. Now, I want to be clear that most mortgage products, an inspection is not needed in order for you to get a mortgage. However, when you're purchasing a home, it's in your best interest to get an inspection because the inspection is going to tell you the condition of the home. So, for example, what's happening with the wires behind the walls? What's happening with plumbing? What's happening with the appliances? Is there any water damage that you might not be able to see with the naked eye that maybe an inspector can see? And so once you get the inspection, that's like your first out. In other words, is this even going to work? Because if the inspection produces some issues that could cost you thousands and thousands of dollars after you close, and the seller's not willing to help you now, then that might be the opportunity to say, you know what, the house is beautiful, the price is right, but based on all this stuff that needs to be repaired and taken care of, it's not for us. Another option is the seller will do the repairs before you close. And then another is the seller will give you a credit to do it yourself after closing. They'll give you a credit in closing costs, which is a fairly common thing. But the inspection is not a condition. However, the inspection is also very important in getting what your homeowner's insurance is going to be. Remember before I kind of gave an example, is your homeowner's insurance $2,000 or $5,000? Well, once you get an inspection, the inspection is going to determine the shape of the roof, or how old is the electric box that controls all the electricity in the house. Those two things can make a difference of $1,000, $2,000 in your premium home in your annual homeowner's insurance. The inspection can help you, it could also hurt you, but nonetheless you want, and I highly encourage you to get it, but it's not required by us, the mortgage lender. Now there's another report called the appraisal, and what we do in underwriting is we order the appraisal. And this is typically $500. Sometimes it's a little less. Sometimes it's a little bit more, depending on what part of the state you're in, or what state you're in, and also the product type or the mortgage type. If you're getting an investment property, the appraisal is going to be a little bit more because we're adding a report called the rent roll, which is a report that shows roughly what the market value of the rent would be if you're purchasing as an investment property. So it's a little bit more expensive. If you're buying a single family home or primary residence and it's a regular standard home, then the appraisal will hover around the 500 mark. If you're buying a mansion or a large home that's 5,000 or 7,000 square foot, that's also going to be a little bit more expensive because it takes a little bit more time. So generally speaking, the appraisal is $500. Now the appraisal is what determines the value. So when an appraiser goes out to the home, they're, for the most part, going to confirm what the home, if the home matches what's in public record, how many bedrooms, how many bathrooms, and they also want to make sure there's no health or safety hazards that they can see with the naked eye. So I'll give you an example. If they look up on the ceiling and they see brown stains, that's the result of water damage. That can be a problem. So this is different than the inspection, because an inspector is going to go into the home and pick the whole home apart. For an appraisal, they just want to make sure it matches public record. They're looking at price per square foot compared to other homes in the area. But again, if they see something that can be considered dangerous, like exposed wires or broken glass in a window, they have to report that, and that could be a problem. So most of the time when that comes up, the seller usually makes the repair if it's not significant. If it's a major problem like a bad roof or something like that, that can stop the whole deal and the whole thing could fall apart. So an appraisal becomes very important. That is required when you're getting a mortgage. And by the way, for those of you out there who might be paying cash for a home, who don't need a mortgage, you also do not need to get an appraisal. An appraisal is only for someone who is getting a mortgage. It's required, although I always encourage to get an appraisal no matter what. Now, if you are refinancing, you don't need an inspection, but it's good to get one if you've done some improvement. So if you are refinancing, you do not need an inspection like you would if you're buying. However, if you have high homeowners insurance and or you have completed home improvements to lessen the insurance, like a new roof or new windows, this would be the time to get a new inspection. That could save you hundreds and even thousands of dollars over the course of a year. So if, let's say, you're paying $4,000 a year in homeowners insurance, and since you've taken on that policy, you have a brand new roof, that could lower, and most likely will lower, the premium of your insurance. So instead of paying $4,000 a year, maybe it drops down to $3,000 a year. And because your closing costs are rolled into your new loan, it will lower your loan amount by $1,000 in that scenario, which then lowers your monthly obligation. In addition to that, because your monthly insurance payment has also decreased, your overall mortgage obligation will also be lower, simply because you decided to move forward with getting a new inspection for the purpose in getting lower insurance. Again, this has nothing to do with us, the lender, and this is your choice, which then it lowers everything as discussed. So after all those things, we're now doing after we've ordered the appraisal, you've signed the e-disclosures, we're also getting the next round of paperwork, which would be updated pay stubs, updated bank statements, maybe a couple things that the processor noticed that we didn't have, like there is an address that popped up in your credit report that we didn't talk about, so we might need a letter of explanation of what that is. Maybe you're self-employed and we need a letter from your accountant. There's several things at this round that you're going to need to send in. We've already done, when you sent in the original round of paperwork in the pre-approval, that was about 80 to 90% of the heavy lifting, which means there's still 10 to 20% left that happens once we go into processing and underwriting. So at that point, we've submitted the file to underwriting. We're under contract or refinance. We've pushed the button into processing. We have gotten the next round of the updated pay stubs. We've ordered the appraisal. You've done the e-sign. All of that has happened. And now we submit to the underwriter. Now, the underwriter is different from the processor. The processor's job is to make sure the underwriter has everything that the underwriter needs to issue an approval or loan commitment. Remember, we did a pre-approval, which is on the front, like based on everything we see, you should be fine. And we have all the paperwork confirming all that. And approval, a loan approval or loan commitment, is the underwriter has looked at everything and it's come out of underwriting. Usually takes about 2 or 3 days, depending on the lender that you use and how backed up they are. You then get a loan commitment or a loan approval. And that means that we're going to be ready to close in a few weeks. In order to get to that point, we need another round of paperwork, which is typically the third round. Maybe some questions, or maybe there was a page missing from a bank statement or a pay stub. There was something on there that needed explanation. So it's kind of miscellaneous I's dotted, T's crossed at that stage. At that time is typically when we're going to be locking in the interest rate. And then you do an e-sign rate lock form. Maybe, maybe not, depending on the market. So when it comes to interest rate, sometimes we might do it at the very beginning. Sometimes we might wait. Sometimes we might do it at the very end. One of the services I believe mortgage professionals should provide is the ability to advise their clients when they should lock and when they should not lock. So for example, if the rate is X, but there's some things happening in the market that makes a lot of experts believe that the rates are going to go down, then you should wait to lock the interest rate. If a lot of experts out there believe that the interest rates are going to go up, maybe that's the time to lock the interest rate before they go up. When it comes to locking the interest rate, there's upsides and downsides, and this is also important to make notes of. When you're locking the interest rate, the downside is if the rates go down, you're stuck because you locked in the interest rate. And a lot of people might lock in the interest rate before the rates go down because they want to take more of a conservative approach and they just want to be done with that part of it. Some folks like to gamble a little bit. I guess that's the word to use, because if the interest rate is at a certain number, but I believe or you believe that the rate's going to drop, then you hold off on locking it. And so that's going to be determined like when. So for example, if you lock it for 55 days, 40 days, 25 days, 15 days, those are different locks. So we want to make sure we lock it with enough days to where the lock will still be in place when you close. So for example, if we're 30 days away from closing and we lock the interest rate, we're going to want to lock for 30 days or more, because if we lock for if you're closing in 30 days and we lock the interest rate on a 25-day lock and we don't close within 25 days, then your closing costs are going to be higher because it costs money to extend the lock. So why would you lock on a 55-day, a 40-day, a 25, and a 15-day? How do you know which one to choose? Well, the shorter the term, like a 15-day lock is going to be the lowest rate. A 25-day is a little bit higher, but still lower than 40, which is still lower than 60, right? And so some people who are really conservative, they say, let's lock the rate now, get done with it, and it's a 55-day lock, and that's what it is. If we're waiting because we want to take advantage of the lower rates and we wait long enough to get the shortest term, that's going to give you the best rate. So I'll give you a basic example. If you are purchasing or refinancing and we haven't locked yet because the rates have been moving in our favor, going lower, and now we're within 15 days of closing, we're going to do a 15-day lock, which is the lowest rate of all the different days, and you're getting, plus we waited long enough to where you benefit the most. All of that being said, you should be in a position, in my opinion, and you should have the relationship with your mortgage professional to where you trust what they're telling you is true and accurate, and they're looking out for your best interest. And it is up to us as mortgage professionals to make sure we're monitoring the market so we can make sure you're getting the best interest rate. We get the interest rates from all the same places. Some mortgage lenders, banks, brokers, credit unions might have different profit margins than others, but for the most part, we get our rates from the same places. Most mortgage professionals, in my experience, are pretty competitive, and it just comes down to, again, my opinion, who do you feel most comfortable with in going down this journey? And then after that, who's going to give you the best advice of when to lock and when not to lock? So once you do lock, then we're going to send you out another form where you say, yep, I agreed to lock, I agree to move forward, and that part is done. And also around the same time is when you want to commit to homeowners insurance. Now, on a purchase reminder, you can't get an accurate quote until a homeowner's insurance agent reviews the inspection. So you want to make sure that different agents, if you're shopping, that you look at a couple of different homeowners insurance agents and they've each looked at your inspection so they can give you the lowest possible premium annual cost for insurance as a result of your inspection. If they don't see your inspection, they have to go off a public record and you're going to get charged the most. If you do have an inspection, the inspection is going to give discounts. For example, in Florida, maybe there are hurricane windows or the roof is brand new. Those are two things that are going to make the homeowner's insurance lower. So you want to make sure that you are you are committing to your homeowner's insurance agent and policy around when all of this is happening, which is usually processing and underwriting is usually all of this is happening about 7 to 14 days after you are under contract, or if you're refinancing, we've pushed the button. So this is around the 7 to 14 day mark that all of this is happening. So conditional loan approval or loan commitment, we'll elaborate a little bit more on that. We get back the loan approval or loan commitment with conditions, usually around 15 to 20 days after you e-sign. And again, as I mentioned before, this is the round 3 portion of the paperwork. And we're getting things like updated information, explanations, just to kind of recap what we just touched on a little while ago. So once we get the conditional loan approval or loan commitment, if you're purchasing, that's a deadline milestone. So on your contract, when you are signing the contract to purchase, there's actually a section that says you have a certain amount of days to get a loan commitment. Some realtors put in 21 days or 30 days or 10 days or 45 days. So that's how much time you have to do all of this, so then we can produce a loan commitment. In my experience, the loan commitment usually takes about 15, maybe 20 days. A lot of buyers' realtors or buyer's agent will usually leave that section blank, which says in parentheses, if you leave the section blank, it defaults to a 30-day loan commitment. So that means we have all this time to do everything we need to do so we can say, okay, you're approved. We have a loan commitment. We just need you to send in an updated bank statement, an updated pay stub, or a few other miscellaneous things. And then we're going to be able to write you the check and you can close. And same thing with a refinance. By the time we get the loan commitment and conditional loan approval, we're not too far away from being able to get to the closing table and make it all official. And at that time, if we haven't locked the interest rate, once we get the loan approval or loan commitment, that's a milestone that lets us know we're not far from actually closing at the closing table. And if we haven't locked the interest rate by now, this is when we want to do it. And then what's going to happen is we're going to take all the other items that we're asking for, and then we submit for what's called clear to close. So once it comes out of underwriting with a loan commitment, there are conditions, and we want to go down that list and get everything on that list, which usually doesn't take that long. Again, it's usually miscellaneous items. And then we take everything on that list, including locking the interest rate if we haven't already, and we submit for what's called clear to close. And that's a huge, huge milestone. The next step is the review and clear to close. At this stage, we have now locked the interest rate. We know what all the insurances are. We know if there's any association fees, homeowners association fee or condos association fee. We also know what the real estate taxes are, if there's a mortgage insurance. And because we've done all this, we can now go over what your payment's going to be. And the intention and hope is that we are within the original budget, which as we move forward, what I like to do is make sure we are at or below budget anyway. But at this point is when the numbers are hard when it comes to your mortgage obligation. We also are waiting for the official clear to close. So remember in the previous slide when we were doing the getting updated items for the loan approval or the loan commitment, we're getting that list so we can submit for clear to close. Now that we've done that, we're waiting for the underwriter to say, okay, the file is clear, you're clear to close. And that means we can now schedule the closing. Clear to close means that you as the borrower have done everything possible except for showing up and signing the paperwork and or wiring money if you're purchasing at this point where you'd be talking about wiring the balance, which I'll get into in a moment. But clear to close means that you've done everything. Now, sometimes when it's submitted for clear to close, the last set of conditions that were submitted to get a clear to close, that might inspire another question or another concern or another condition. So we don't want to assume that because we're submitting for clear to close that we've done everything we needed to. It means that we're hoping the underwriter has everything they need to issue the clear to close. And in some cases, they'll come back and say, we need this or we need that. So we want to be prepared to get the underwriter anything they ask for at this stage as quickly as possible so we can schedule that closing. Once we do get the official clear to close, at that time we set up the time to close at the title company. Now, in today's day and age, we can do what's called a mobile notary. So in some cases, you can do the closing out of state. For example, I'm doing a refinance at the moment for some past clients. The wife is at home while the husband is in a different state on business. So we're actually going to be emailing the package to someone who's going, it's called a notary, and you may know someone who's a notary, and there are some notaries who specifically do mortgages and what's called mail-aways where they're in a different state. So we're getting the entire package to be signed to the other state, and a notary who's going to take the package and meet with the borrower, and then they're going to FedEx the package back. And then the wife who's in Florida, she's going to sign the same package, and then we submit it back to us with everything signed by both parties. In some cases, maybe someone's buying a second home or investment property from out of state, same thing. We get the package up to whatever that said state is to close for the property down in Florida. Most of the time, the standard way of doing it is you, the homeowner or home buyer, drive to the title company's office and you sit across a table. They review everything that you and I have already reviewed, or your lender should have already reviewed with you, all hard numbers, everything you need to close. But at that time, we're setting up the time, whether you're going to the title office or we're having someone come out to your home after business hours, or if it's out of state, a mail away. So there are several ways of closing the paperwork on a mortgage, but at this time, we're setting up the time. So closing, our back-end team sends information to the title company to work on final hard and approved numbers. So reminder, we've gotten the clear to close. I'm now asking you if it's a refinance, when do you want to close? If it's a purchase, we know when we're closing because the contract has a date on there, unless we are bumping up the closing because we're prepared sooner than the contract date. But once we find out the time and the date, we get back to our back-end team. We say, okay, here's when the closing is going to happen. And this is important because the back-end team is going to work the numbers and get all the exact numbers down to the penny based on the day the mortgage is closing and funding. And this is important. Our back-end team is going to send some paperwork to the title company. And at that point, the title company and lender, in this case it'd be us, they go back and forth until they have what's called a final closing disclosure. Now, if you remember at the very beginning, you did preliminary closing disclosures with numbers that are not accurate. At this stage, the numbers are in fact accurate. We know everything. We've already talked about the payment because we locked the interest rate. This part of it is confirming, if you're purchasing, how much cash is needed to close. In other words, let's assume you needed $30,000 to close, and we talked about at the very beginning, and you've given a $5,000 deposit up front. That means that we're expecting you owe $25,000 at this stage. Maybe the cash to close comes out to $24,122.67. And so at that point, you will have the final closing disclosure that says $24,000 and whatever down to the penny, which at that point we realize is lower than what our original budget was. But that's when we find out those final hard numbers, and that's when you're going to wire the money. So, which is the next bullet point. Once we're clear on the final numbers, you're going to wire the balance of what's needed to cover the rest of the down payment and closing costs for your purchase. For a refinance, we just simply review the numbers. So at this point, I'm going over with you the final closing disclosure, or your lender should be going over with you the final closing disclosure, because that's what you're actually going to be signing at the closing table. So ultimately, you want to make sure that when you're at the closing table and you're looking at this paperwork, you've already reviewed it, so you know exactly what you're looking at when you sign it. And that adds, in my opinion, that adds to the experience. Now, if you are purchasing and you need to wire the rest of your down payment and closing costs, right, to equal out what's due, you want to make sure that that money is coming from an approved source. In other words, if let's say you need $25,000 to close, you can't pull out a duffel bag and take it over to the title company and say, "Hey, here's my 25,000." That 25,000 needs to come from accounts that we have already verified in all the initial stages. If it's a gift, we've gone through all of that in the initial stages. So at this point, you just want to make sure that the money is that your wiring is coming from a source that we've already verified. And again, on a closing, we simply make sure all the numbers match up and meet and or exceed your expectations. So remember, when we first had our consultation and we created a strategy, we went over the numbers. You said on a refinance, hey, this is what I want the benefit to be, or even on a purchase, right? In the consultation, you're talking about what result you envision, how you want this to work out. And at this point, we're going over everything to make sure that we've done exactly what we've talked about. And the hope is that it's better and in your favor than what we originally talked about. So then there's closing day. And closing day, again, if you're going to a title company or the title company or a notary is coming out to you, all you need to do at this stage is make sure you have your IDs with you. You're going to sign some paperwork. It usually takes about 45 minutes. So the first 5 or 10 minutes of a closing, whether refinance or purchase, they're going to go over all the stuff that your lender, or me in this case, would have already gone over with you. So interest rate, mortgage balance, what's your total monthly payment, how much cash do you need to close? If you're doing a refinance and you're getting cash back, how much cash should you expect to get back after closing? And these are the final closing disclosure documents. They're going over closing costs and all of those things that we've discussed already prior to you sitting down to signing. If you are not using me and you're already working with someone, it's important to say, I want to see the final closing disclosure and all the numbers. I want to be very clear on the numbers before I sit down for closing and signing all the paperwork. So once you get to closing, whether a mobile notary is sitting in front of you because they came to your home or your hotel or wherever it is, or you have driven to the title office or maybe even a real estate office. Sometimes closings take place at the real estate office. When you sit down, the first 5 or 10 minutes is going to be the interest rate, the closing costs, the fees, the loan amount, all that important, very important information. That all takes place in the first 5 or 10 minutes. After that, you're going to sign a pretty big stack of paperwork with a pen that pretty much says, in just a basic general summary, that you are who you say you are. You have the intention of making the payment and on time. You understand what problems could come up if you don't make the payment, and then all the other papers that go with it. And so the closer, the notary or the title company who is doing the closing, they can go over each page with you very slowly if you ask them to. They can breeze by it if you say, listen, I just want to know that the numbers are accurate and it's all good. So whatever your speed is, the average is about 45 minutes, give or take, depending on small talk and conversations. But that's what you can expect if you're planning your day around the closing. That's usually what it takes. It's about 45 minutes. Once you sign the paperwork for 45 minutes, the person who did the signing, if you're at the office, what they're going to do is take all the paperwork. If you go to a title office or a real estate company to do the signing, they're then going to take all the paperwork that you've signed and they're going to send it back to us, the lender, or whoever lender you're using, but they're sending it back to the person responsible for saying you're good to go. On average, that can take about 15 minutes. In some cases, it can take several hours. Maybe the title company is busy that day. Maybe the lender is busy that day. There's a lot of reasons why it could take longer than 15 minutes. But by then, you've pretty much signed everything. So maybe you need to go. You've got moving trucks ready, or you've got to get back to work. And if anything else needs to be done at that stage, the title company or whoever helped you will be able to let you know, hey, I need you to do X, Y, and Z. Most of the time, you don't have to wait around. Sometimes people do. Like if you're purchasing a home and you're dependent on getting the official word, sometimes you'll stay until you hear, okay, everything's official and funded. But typically, once everything is signed, about 15 minutes after that, you'll hear you're funded, approved, and you're official. And now, if it's a notary who's coming out to your home or place of business, that's usually not going to happen until the next day when everything is funded officially, generally speaking. Soon after you've signed all the paperwork, the lender has, or the title company or notary has submitted everything in, and the lender or the lender has all the paperwork needed, and they respond with funded or you have permission to fund, that's when it's official. And now you can celebrate. When you are purchasing a home and you are signing paperwork and the title person says you are funded, you are now a homeowner. Sometimes if you are signing at, let's say, 4 or 5 o'clock in the afternoon, it might not fund until the next morning. But once you hear funded, that's when it's time to celebrate. Now, if you're doing a refinance, when you sign the paperwork, there is a 3-day waiting period, and you can Google what days work. It's not just Monday through Friday. Holidays are involved, and Saturdays and Sundays. Those different days sometimes cause different restrictions. So if you want to find out exactly how many days from the time you sign, it depends on those factors. But typically, it's 3 days after you sign is when it becomes official and everything funds. So for example, if you're doing a refinance and sign on a Monday and you're doing cash out, you can realistically expect the cash that you're taking out of your home to be in your bank account by Friday end of business day. So let's recap the 6 easy steps to buying or refinancing. Number 1, the initial consultation. We're going to get on the phone. We're going to talk about what your goals, situation, and objectives are. And this starts the pre-approval process as well as your custom strategic mortgage game plan. The pre-approval is the stage where we've had our consultation. You have filled out, or I have filled out with you, the online application. You've sent in all of your documents, including your tax returns, W-2s, pay stubs, bank statements, anything that we will need during the buying or refinancing process. And we've generated an official pre-approval. Once you're pre-approved, if you are purchasing, once you go under contract, it then goes into processing and underwriting. If you are refinancing and we're clear on the strategy and it feels good, we go into processing and underwriting. And this is the stage where there's a team of professionals behind the scenes that support me to be able to support you, that are working on all the paperwork to get to the closing table so the numbers work out the way that we talked about or better. The conditional approval is it's been in processing, it's gone through underwriting, and the underwriter, who goes through everything with a fine-tooth comb, sends out what's called a conditional approval, or you may hear the phrase loan commitment. And this is, hey, we've looked at everything. We are prepared to cut a check. We are prepared to close. However, we need you to send in X, Y, and Z, which at that point, there's a new revised list of what needs to be submitted to finish the entire process. And once you submit those other conditions, at this point, we have locked the interest rate, we've had our strategy, we have the approval, so now we're going to review the numbers, not the cash to close or not what the final closing costs are going to be, because we don't know that yet, but we are going to review your payment, so we know what your monthly obligation is. That's what we do know, is what your monthly payment's going to be, so we can compare it to what we originally spoke about. And then we submit for clear to close. And then once the file is submitted for clear to close, that means that everything is done from a borrower's perspective, and the only thing to do after that is a couple of miscellaneous things for the purpose and intention of closing. So the clear to close means that you and I and the rest of the team, we've worked so hard, and it's a huge milestone. And then the last step is day of closing. So around that time is when, if you're purchasing, you're going to know what the exact dollar amount is. We've looked at the final closing disclosure with all the exact cash to close down to the penny. You're going to wire the rest of what you owe to the title company so they can close on the purchase. If you are refinancing, we've gone over all the numbers so you know what to expect when you autograph the paperwork. That way, when the person sits down in front of you to go over all the paperwork, you're very clear. There's no surprises. We've put you in the position where we've accomplished what you want to accomplish because we spoke about it, and what's left is just to autograph the paperwork for about 45 minutes and wait for the title company to say, congratulations, you're funded. On a purchase, most of the time it's the exact same day. Sometimes it parlays into the next business day. On a refinance, if it's a primary residence, it takes up to 3 days for everything to be official. On an investment property, it's actually the same day. But that is closing day, and these are the 6 easy steps to buying or refinancing recap. You've heard officially funded, whether you're purchasing or refinancing, and now it's time to exhale. And now you can jump for joy, and now you can celebrate. You know, there's a saying that I always tease my wife about, that it's not money in the bank until it's money in the bank, right? And until you hear the official word, I always don't like to exhale until that happens, because that's when it becomes official. But once it's official, take a deep breath. It's all over. Well, this part of the journey anyway. That is the 6 easy steps to refinancing and purchasing a home. And I want to ask you, did you get value from this time we just spent together? And are you interested in hearing about the next step? And if you were to receive a complimentary consultation that helped you create a strategy, do you think it would be worth your time? Well, I hope you answered yes to those questions, and I also am sticking to my commitment, and you stayed till the end, so now I'm going to share with you some of the bonuses. Here is your first bonus. I'm going to share with you how to save thousands of dollars in cash out of pocket up front, which is part of your custom consultation. And it's a technique I use all the time. And this specific one is for purchasing a home. So what you're going to do is, in the offer, when you're making an offer, you're going to ask the seller to pay for 3 to 6% of closing costs. And instead of you paying them out of your pocket, the seller does. So on a $250,000 purchase, that's between $7,500 and $12,500 in cash, and you get to keep that in your pocket. So if you're buying, let's say, a $250,000 home, and let's say some people say, well, I want to offer $240,000, right? So you're asking them to drop $10,000. What I suggest is, because ultimately you're wanting to save $10,000, but if you drop $10,000 on the purchase price, it's really not making that much of a difference. It means your mortgage balance is going to be a little bit lower and your down payment's going to be a little bit lower, but you're not actually going to save $10,000 in cash unless you're paying all cash for the property. In my perspective, the biggest benefit of utilizing a $10,000 difference from a seller is to give them the $250,000 that they're asking, but ask them to pay $10,000 worth of your closing cost. So if you have $30,000 that you are using for your down payment and closing costs, and all of a sudden the seller is willing to pay $10,000, that means that instead of paying $30,000 to purchase your home, you're only paying $20,000 to purchase your home, because the seller gave you $10,000 of their profit to cover your closing costs. And that's a huge, huge thing, especially if all you have is $30,000. Imagine what that $10,000 could do for you in terms of painting or cosmetics, etc. Now, I would like to add that in the current lending environment, which right now is a seller's market, it's not very common for a seller to contribute closing costs unless they are desperate, the house has been on the market for a while, or there's just not a lot of action for that particular property and the seller is willing to help. Another really good technique that can work is to save, let's say, that $10,000 in this particular scenario. You actually offer $10,000 more than the asking price, and then you ask the seller to contribute the same $10,000. Now, this is only helpful if the home appraises for what your offer is. So, for example, on a $250,000 purchase, the seller says, no, I'm not interested in contributing money for your closing costs. However, if you say, well, then I'll give you $260,000, and the seller will say, well, okay, because the seller, he or she is still getting what they originally wanted. So then the offer agreement would look something like this. $260,000 offer. The seller is going to pay $10,000 toward the closing cost. Now, the appraisal needs to appraise for $260,000. If it does not, then it defeats the purpose. So cross your fingers and hope that it appraises for that. And if not, you have to resort back to your original plan, which is you have to pay what you were originally expecting to pay anyway. If you have no option and you're dependent on that money, then you can see why it might be an obstacle, or cross your fingers, you might get lucky. But this is a way to really save a lot of cash. Now, on an FHA loan, you're allowed up to 6% in seller concession or seller credit. On a conventional loan, the max is 3%. And that is just generally speaking. I want to give full disclosure that the seller giving a credit of 3% to 6% is relative to a specific product, the certain product type. It could be a little bit more, it could be a little bit less, but the general rule of thumb is 3% to 6% roughly. If the appraisal comes in for less, here is an example of what this looks like. So first off, let's go through the example. The listing price is $250,000. And you offer $260,000, so you can get back $10,000 seller credit to cover $10,000 of your cost, which then keeps that $10,000 in your pocket. And let's say the appraisal comes back at $255,000. Now the good news is it's $5,000 more than what they originally wanted, but it's $5,000 less than your offer. So instead of getting back $10,000, you're only going to get back $5,000, which is better than nothing. Now, if the appraisal comes back at the original listing price of $250,000, there's most likely no credit. So that $10,000 that we originally wanted becomes removed because of the value. Now, if we were counting on that $10,000 so you could close because you simply didn't have it or for whatever reason, and it comes back at $250,000, there's a couple things that happen at this point. Either it doesn't work out, so we cancel the loan and you get back your earnest money deposit because it didn't appraise for what we needed it to in order to close, or you have to come up with the difference of what you want. So even if it comes in at $248,000, there's a $2,000 difference. You might have to come up $1,000 or $2,000, or maybe the seller comes down $1,000 or $2,000. But the only time if the appraisal comes in at $250,000 in this particular scenario, and the reason I say there's most likely no credit, because maybe the seller is willing to still give you a credit because you're far along. But at this point, the odds are likely that it won't happen. But you never know, it's possible. And touching on what I said a moment ago, now if the appraisal comes back at $245,000, which is $5,000 lower than even what the original listing price was, not only will there be no credit, but you may have to pay the difference or split it down the middle. In other words, if there's a $5,000 difference, either the seller comes down $5,000 to match the contract price, or the seller comes down $2,500 and then you pay an extra $2,500 out of your pocket to make it work. That's split down the middle. Or the deal is canceled and it doesn't work out because neither one of you were able or willing to budge. So those are the examples if the appraisal comes in for less than the contract price. Another way to absorb some of your costs that I use all the time is a lender credit. So as a lender, I can actually raise the rate and give you back money at closing, so it's less cash out of pocket. And this can range typically from 1% to 3%. That is based on your credit score and several other ingredients. For example, what's happening to the market at the time we're going to lock and what as a lender, what am I able or allowed to do for you personally in your situation? So I'll give you an example. Let's say, again, you're $30,000 out of pocket and your interest rate is 3.5%. If we raise it to 4%, I might be able to give you back a credit of $5,000 on a $250,000 purchase. That just gives you a general idea. So if you say to me, Jay, I want the lowest interest rate, then the credit will be removed. You can't get a credit. If you say, Jay, I want a lower interest rate than what you're giving me, then you have the option of actually buying it down, but then your costs become higher. That's the discount points that we're talking about. If you want a credit from me, the lender, you have to be willing to take on a little bit higher of an interest rate. So maybe it might cost you an extra few dollars in your mortgage payment, but at least you're keeping some cash in your pocket, and then you just have to decide what's best for you and what's a priority. This is case by case. We can review your situation when we speak, or if you're dealing with another lender, that's something you want to speak about is, hey, I would like to get a lender credit. Do I have the ability? How much can I get? And what does that look like? But this is another opportunity. Just to recap, you can lessen the cash out of pocket based on several things. One is actually not listed in this PowerPoint, but I encourage you to write it down. One is the seller giving you a credit to cover some of your closing costs. Another way is I, the lender, or any mortgage professional, should be able to give you back a credit if you're willing to take on a higher rate than what you're already qualified for. Another option is you may want to ask your realtor, depending on how much effort they're putting in, the work that they're doing, the size of the property, they might be willing to contribute a little bit of their commission to help you if needed. I just want to disclose that real estate professionals work very hard. There's a lot of running around they do, and they deserve every penny they get. But if you're in a crunch and you need $1,000 or $2,000, or your mortgage may fall apart, you may want to ask your realtor to contribute if that's the last resort to help with your closing costs, and that would be a credit as well. So you have seller credit, lender credit, realtor credit, all of those, and then a combination of any of those to absorb some of the costs that come out of pocket. That can be many, many thousands of dollars that if you structure it properly, you could keep that cash in your pocket and use it for not only retirement or renovation or pay off some debt to make your monthly obligations lower. Lots of benefits, obviously, in taking advantage of some of these techniques. Let's recap how to have costs or cash out of your pocket be less. Number one, the seller credit of 3 to 6%. This is most common. Depending on some products, some investors in a particular product might allow only 2%. And some cases you can get up to 8%, which usually costs aren't going to be that high unless you're paying points to buy down the interest rate. But the most common in my experience is a seller credit of 3 to 6%. That means that whatever the contract price is, the seller will contribute between 3 and 6% of that price toward your costs. That could be thousands of dollars. The other way to have your cost out of pocket be less is a lender credit, where you ask me, hey, listen, I need or want help with my closing cost. And then what happens is we have to raise the interest rate to be able to give you back that credit. We know what that number is. Sometimes, depending on the investors in your situation, maybe depending on credit or how much cash you're putting down. And if you remember the acronym DICE, debt, income, credit, equity, which is what determines a borrower being pre-approved or even closing, could also determine and be a factor in how much of a credit I, the lender, or any mortgage person can give you. And when the rate gets locked is typically when we do this. Now, if we lock the interest rate toward the beginning and you said, hey, I need to get a lender credit back, can we still raise the interest rate at that time? The answer is yes. So we have some time to do that, but that's another way to get closing costs paid for and to be able to save cash out of your pocket is the lender credit. The third way of doing it is a realtor credit. So only if needed or the contract could fall apart. Now, this is more of a suggestion and my personal advice, because realtors, they work hard. They do a lot of running around to make sure that you found the house that you want. And there's a lot of back and forth with the listing agent to get you in that position. And real estate professionals deserve to make the money that they're making. With that being said, if let's say the seller has given you their max credit, or if they were unable to, I've given you, as the lender, the max credit, whether we were able to or not. And the only other way to get a credit from the professionals that you're surrounded by is for the realtor to sacrifice some of their commission. And in that particular case, it's just a matter of having the conversation. 9 times out of 10, a realtor is going to give you a credit if you need it to close, because if they don't, then the deal falls apart anyway, and they don't make anything. They don't earn, or they have to go back and start all over again. So most of the time, that's a good business decision for a realtor to help if needed. And then the last option, in my experience, is a combination of any of the 3 above. Now, another bonus I wanted to share with you that I can go over with you simply because you've attended this webinar is the How to Budget worksheet and consultation. Now, sold by itself, this is valued at $200, and what it is, it's a spreadsheet that is quite valuable. Budget worksheet. You'll be able to list all weekly, monthly, and yearly expenses, and I'll show you what it looks like when we list everything. You're going to see how much cash is going in and out every 30 days. You're going to be able to determine what you can cut out to increase cash flow or increase budget for a new home. And you're also going to determine how much money you need each month to add to savings or retirement. So here is what the budget worksheet looks like. It's an Excel spreadsheet, and you can see at the top we put the date, Joe Smith, and so I'm using my mouse right now, so you can see job 1, job 2, job 3, investments. These are the ways you're bringing in income. Maybe your job 1 is your main source of income, but maybe you have something on the side that you do, or you sell things on the side. So this is what we're putting in here. Maybe your job 1 brings you $6,000 in monthly income, and then you also earn $100 a week doing whatever, or which is $400 a month, et cetera. And this all goes in there. And then here's the other category. We've got your housing expenses. So if it's a mortgage, maybe it's $2,500 a month you put in mortgage. If you have a second mortgage, some people have. Typically, your mortgage payment includes your taxes and insurance, so you don't really need to put anything right in there. But some of you maybe already have a home and you're paying just principal and interest. This is where you put in mortgage insurance, property taxes, homeowners insurance. But most people just have one monthly payment that covers everything for their mortgage. But maybe there's a homeowners association, so there's a $300 expense. In this section also are your utilities, your electric, your gas, water, phone, internet, just basic stuff that you need per month. And the average household with all of these might spend about $600. So between your mortgage, utilities, and HOA dues in this scenario, you're at about $3,400 a month, which is about 46% of income on a $6,000 a month income. And then when you got education expenses, maybe you have some student loans, put in like a $400 example there. Healthcare expenses, maybe you go to the chiropractor, or I like to consider massage as part of healthcare, which I think is important to do at least once, sometimes twice a month if you can, and hopefully once a week. It's a great way to really get relaxed of all the stuff that we deal with, which is to hire someone to give a massage, unless maybe you have a partner who can do that for you. Medicine, pharmaceutical drugs, prescriptions, et cetera, other things. So, maybe that's $300 a month. And then transportation, right? How much do you spend each week in gas? The average person spends $50 a week, which is $200 a month. How much do you pay in auto insurance? And maintenance, maybe it's $200 in auto insurance, and maybe twice a year you have to spend $500 or $600 in maintenance, new tires, oil change, etc. Maybe that's $3,600 for the year. Your car loan or 2 car loans, right? How much is that? $600 a month. So the transportation and auto, you can see, can add up as well. Okay, and then we have general lifestyle expenses. Everyone has a cell phone. What's your cell phone bill? Groceries. This is important that the average adult spends about $200 a month in groceries. So 3 people in a house is $600. And if you're like me, I actually spend more than that because I'm always wanting the best quality and I eat a lot of food. So my grocery bill, with my wife and my son, it's pretty much, it's up there. Clothing, maybe it's $50 a month. Maybe every few months you spend a few hundred. Or I have a 2-year-old son and another one on the way. So that budget for me is going to be increasing. Entertainment, movies, restaurants. Maybe you go out once a week and spend $50. Cable, satellite TV. I don't use that, but I'm guessing maybe it's $50 if you can get a cheap monthly subscription to cable or satellite. And then subscriptions, memberships. I have Netflix and I have YouTube Premium, and some people have Spotify, and I'm on this Masterclass.com, which is all these different courses that cost money. So subscription, membership dues, that's there. Hobbies. What are you doing each month? Like right now, one of my hobbies, a couple of my hobbies is exercising and learning things that I enjoy. Like I'm studying things on homesteading and being able to live off grid and exercise and health and better sleep and better wellness. So all of these things are hobbies, and it costs me money to do these things or go places to enjoy myself. Maybe credit card payments. The average person has $10,000 in credit cards, and the average monthly payment is $300. So total general lifestyle expenses, we're down to $1,350. So in this particular scenario, we've got total spending of $6,500 a month, and so far, and then saving and investing. How much are you paying down each month toward debt? Maybe you want to put a few $100. Maybe you want to take $1,000 a month and put it in retirement, right? And then giving. Do you go to church or synagogue or a mosque and weekly or a couple times a week, and how much do you donate? Charities, do you go to charity events, or do you put checks in the mail to send off? So these also add up. And so in this particular scenario, we're negative. This is showing we're negative $1,550, which is an annual of, well, actually that number's a little off, but you can see what I mean by that. This gives you a breakdown of how much negative everything is at the moment. And on the other side of the coin, I just went up and I increased my monthly income, and it also shows surplus. So if it's in the red, you're a shortfall. If it's in the black, that means you're positive cash flow after everything is here. So that should be going in the bank. And this is someone, if someone's filling out this scenario, this is someone who's living under their means, because 30% of their net income, which is about $2,450, is going in their bank account. So these are all really good things. This is the budget worksheet and consultation that I go over with you, or I can just send you the spreadsheet and you can do it yourself. Another bonus that we spoke about is your credit report and credit score boost consultation. So what we would do in this scenario is we will review your credit report line item by line item with the intention of making sure your credit score is optimal and at its highest. So to give you an example, the higher the credit score, the lower your mortgage interest rate and the lower your payment will be. Or on the reverse side, with a higher credit score, you can actually increase your purchasing power, whether it's $5,000, $10,000, or $20,000. Give you an example. I have a client that had a 648 credit score and was limited to her monthly obligation because of a program she did. and she was been shopping for 3 months and kept running into an issue of the purchase of the purchase prices being a little too high for what she qualifies for. Well, she took my advice. She raised her credit score. She went from 648 to 660, and it increased her purchasing power by about $250 a month, which translates into about $40,000 to $50,000 worth of purchasing power because of a 12-point increase in her credit score. Credit score is very, very important. Of course, the credit history as well, but we want to make sure that your score is optimal and at its highest. So in this, you're going to walk away with a detailed game plan on what to do next to ensure your credit report is as good as it can be, and or a lifetime of wisdom on understanding how to have the highest score and without the need of a credit repair company. So when we go over our consultation, you're going to have knowledge and wisdom that you can use for the rest of your life, and you can share it with others. Home and commercial loans. So personally, I have the ability to do a mortgage for you or someone you care about in all 50 states in the U.S. And this is whether it's residential or commercial. So residential mortgage, to kind of give you an idea, is any real estate with 4 residential units or less. So for example, if it's a single family home or a townhome or a condo, those are all considered one unit. If you get a duplex, well, that's 2 units under the same structure. That's 2. A triplex is 3, and a quad is 4. So that means that you can live in a 4-unit building that you own and 3 other units are being rented out. That's still considered your primary residence. Or even if you're an investor, it's still considered residential. And with that, we do FHA, conventional, VA, and then all the traditional types of products, as well as the non-traditional. So the non-traditional, no tax returns. So if you're self-employed and or you haven't filed your tax returns, we have the ability to use just bank statements to get that loan done for you. Or there's another product to where even if you don't have bank statements, maybe you have an investment property where the rental income is a little bit more than what your monthly obligation is going to be for the payment on the subject property. And we can go off of just the rental income on that particular property. No tax returns, no bank statements. So that's a great product. Equity driven only. So you might not be able to produce any paperwork at all, but you have a certain amount of equity in your property. And there are some investors out there that will give you a mortgage to satisfy your intentions simply based on the amount of equity that you have. And so there's a lot of, these are kind of key products, and there's a lot of spawn-off products as a result of that. But essentially, if you own residential real estate and there's something you want to do, we can talk about it and I'll help you create a game plan. And there's usually something for everyone. And if it's not right away, then we create a game plan. Commercial lending. So as I shared with you, a commercial loan is for commercial part 2. Commercial lending. Commercial property for residential is 5 units or more. So we talked about residential is 4 units or less. So if the building has 5 units or more, it automatically is considered commercial, which is a whole different animal. And whether it's a 5-unit residential or a warehouse or a restaurant, a hotel, multi-use, maybe there is a building that has a retail store on the bottom and a residential unit on top, that's considered mixed use. I have the ability to help you with all of that with as little as 10% down. So for some of you investors out there who want to buy $1 million commercial unit, that's only $100,000, right? Versus what a lot of commercial loans require 20 or 30%, which in that case will be $200,000 or $300,000. So commercial loans are popular, and I can help you with that as well. And then we can close anywhere in the U.S. and the world. So if you are buying an investment property in Florida or a second or vacation home in Florida, and you are not in the state of Florida, we can have you sign in the state of Washington or California or even in France. I closed a loan where the borrower was in France. Actually, the husband was in France. The wife was in Canada, and we closed on a vacation home in South Florida. It took a little bit longer, but it can be done. But doesn't matter where you are, you don't have to physically be in the same area as the property in order to close, and we can get that done for you. There are two types of people. The first type is one who is timid or kind of kicking the tires around, just kind of wanted to check into the webinar. Maybe they pick up one or two things, but they're really not interested. Maybe because you might not resonate with the way my voice sounds, or the way I might look, or you just might simply determine, you know what, you can't be helped at this time. You've come to that conclusion, and there's no judgment here, and that's okay. And they decide to move on. If that is you, that's okay. I'll be sending you some valuable content that's going to help you in the future, and I wish you the best of luck. And so in that content will be things that's happening with real estate and credit improvement and mortgage lending. In addition to that, maybe you buy a house with someone else, or you do a mortgage with someone else, and I send you things on how to maintain your home for the long term, certain things to look out for. So everything that I send out has an intention of adding lots of value. And then maybe one day you'll want to speak to me, and that's great. Now, the second type of person feels that this is almost unbelievable, but wants to utilize the resources available now and move forward going through the pre-approval process, as well as get a complimentary game plan creation. And this is whether you're buying or refinancing, or you're doing something now or later. Now, if that's you, here's the next step. There are several options to get started. One is to schedule a call, and this is going to allow you to get on the phone to go over a game plan for the time that's scheduled. So when you click the link below that says schedule a call, you simply select the best time. We're going to allocate time. We're going to help you create a game plan. Option two, there's a link for a quick short form, and this is giving basic general information. You essentially explain what your situation is, what your timing is, if you have any obstacles ahead of you, and it starts the conversation via email. And this way you don't have to get on the phone, and you can do this at 1 o'clock in the morning if you so choose. The next option is the application. Now, this is a deep dive into someone who wants to get pre-approved right now. So the link below will take you to the online application where you're filling in the boxes, who you are, what you do for a living, what's your income. It gives you the opportunity to upload important income documents like your W-2s, tax returns, all of that, because you're ready to get going now. This webinar has given you enough information where you feel empowered enough to get started. You fill out the application, and then we set up a time to discuss it so you can go shopping essentially right away if everything works out. If you're refinancing, we would get things moving right away. That's option 3, the application. Option 4, text to the number you see on the screen. That is going to alert me or one of my team members that you want to hop on the call right now. It's just another option in communication to get things moving forward, and you can expect a response within 24 hours. And the response is between 8 a.m. and 3 p.m. Eastern Time, Monday through Friday, and sometimes on the weekend. Here's a great quote from Gandhi, and he says, "With wisdom, you understand the experience from a new view, a new way of experiencing the world." And how I feel that this relates to this whole experience is you now have an idea of what to expect from the very beginning to the very end, and now you can move forward and experiencing this journey in a new way. I hope this has been as valuable as I've intended it to be. I hope you've picked up some great nuggets that you can apply, whether you're going in a different direction, you would like my team and I to be the ones that are going to help you down this journey. Here's my personal information. You can go to the website, you can look at the reviews, there's my cell phone and text, that's my personal information. Thank you so much for taking the time. Give yourself a pat on the back because you've invested time to become more empowered. Until next time, this is Jay Robbins. I look forward to connecting with you.